you're going to put $10,000 in this IRA because you don't qualify to do a Roth. And so you can still do an IRA contribution, but it's what's called a non-deductible contribution. And so it goes into the account as what's called cost basis. Okay. Cost basis is important to track. It gets tracked with the IRS form 8606 when your accountant does your taxes. And it's important because in the future, when you take money out of your IRA, right, part of the money you're taking out is the cost basis. Well, you've already paid money on that because normally IRA funds are tax deferred, but you didn't qualify for the deferral. You still put the money in. And so you have paid the money on you have paid the taxes on that money. So
information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Charme Wealth Management Podcast, where we aim to give you the insight, education, and knowledge that you need to have more meaningful engagements with the financial professionals around you, whether it's us as your wealth management advisors, it's your accountant, your estate planning attorney, anyone that you need to hire and deal with that could impact your money, your wealth. Today we have Carisa in the studio with us, Carisa Bertrand. She's an advisor with me in the firm. She is located down here in St. George. We work together on a lot of stuff. She brings a lot of insight and she brings a lot of counterbalancing personality to me, which is great. Anyways, today we talk on some tax efficiency ideas, some tax planning stuff that we've been working on with clients, and some general education on some things to maybe be aware of or avoid doing if you are working on your tax planning. So with that, let's jump in the episode and I hope you get something out of it. Carisa, what are some wins you've been working on lately for clients?
That's a great question. There's been a lot of things going on. I think one of the most exciting things is doing some tax planning for a high net worth client and being able to save them like $13,000 this year.
Cool. That's a big win.
It's huge.
Especially like alternatively, my favorite part about tax planning is alternatively, all the money that we save somebody goes to the IRS, which is like the last place they want it to go. So it really frees up a lot of money for them to like chase life's more meaningful endeavors with that money. And it's just not getting like burned at the IRS or by the federal government.
I think it's just, it's just
great.
exciting that it's not going to the government. A lot of people like that.
It's tax planning's fun because it makes a huge difference. It's more quantifiable, like it's less speculative than investments, right? So on the investment world, like in the investment side, we always have to make a projection or some kind of reasonable understanding. Like we expect this to go up, but we don't, if we say like, hey, next year, we really don't know how far the S&P 500 is going to go up or down, and it could be down, but it might be up. Taxes is fun because we're really just saying like, you would pay this much, we can do this, and you're going to save, taxes by making these changes. It gets a little bit kind of back to the investment side when you start doing forward-looking projections, particularly around when you're going to defer gains off to the future and realize them in the future. Because you're taking a guess at that point, so to speak. Like really, it might be an educated guess.
Hopefully.
But there's no, we don't have a crystal ball. We can't guarantee.
The brackets are going to be.
Yeah, we can't. Right. We can't guarantee what somebody's income is going to be 20 years from now.
Yeah.
Right. And we can't guarantee that the federal government isn't going to change, or the city of Utah for that matter, or whatever, any state. They're not going to change the tax code, right?
Right.
But it's more quantifiable. Anyways.
Yeah.
It's fun.
It is. It's pretty exciting, and it's something that all the clients get excited about too. When you can help them with saving taxes and just not sending that to the IRS, it's a really fun thing.
What's one of the tax planning strategies you've worked on with somebody that you found was pretty beneficial that they just didn't know existed?
Well, in the same example here that I mentioned to you on saving a high income client, a high net worth client, over $12,000 this year, we're going to be able to continue that year over year because this is a way that they're giving to charity from their investment accounts rather than taking it from cash. And so that's something that they didn't know that they could do. And so just by making one simple change, they're still donating the same amount to a charity. But by changing where that location is of where the funds are coming from and how we're doing that, just being a little bit more tax savvy with it, they're able to save so much money every year.
Yeah. So in-kind donations.
Yes.
And that strategy only works if somebody wants to be charitable, right?
It's
like
true.
you don't,
true.
You don't get to give money to a charity and then get like a net tax benefit by donating to the charity, because at the end of the day, you're still giving away something that you have. But there's an efficient way to do it, not efficient way to do it.
Yep. So for these clients, their donations, they pay tithing to their church. And so that's something that they already have been doing, that they plan to continue doing. And so just by making a simple change on how they did it was the tax savings for them.
Cool. And let's use some really simple numbers and explain to people not listening sort of how this works.
Okay.
So let's just use the example of somebody bought an investment, just generically speaking, for $200, and over the years it's appreciated to $500, right? And now they have, stock of, XYZ mutual fund or ETF or company in their brokerage account. And, again, they bought their shares at 200. Now they're worth 500. So what's the next step? Like how do they get the tax savings on this?
Great question. So because they have that gain of the $300 dollars per share that they own of that, what we do, instead of having them sell off that investment, right, and sell it and realize that gain of the $300 and then have to pay taxes to the IRS on that gain, what we're going to do instead is we're actually going to go and look at the cost basis and find out, okay, yep, this is appreciated so much more. So we've got that $300, right? We know we don't want to pay taxes on that. So we're going to actually do an in-kind transfer where we take that stock or mutual fund or ETF or whatever it is, right? And we're going to send that directly to the church. So now, or whoever they're donating to, right? And so now that charity, they don't have to pay taxes on the growth of that investment that has occurred, that $300. And the client no longer has to pay on the taxes of that $300, right?
Because the charity's tax exempt. So they get it, they get the stock or fund or whatever, and they can sell it, and they get the $500 that you were trying to donate otherwise. And they don't have to pay income tax because they're a charity. Right. And so now, okay, so you're saying that they're exempt from realizing the $300 in gains, which is significant, right? Long-term capital gain tax, state income tax. If they're in a high enough tax bracket, you have additional investment income tax, additional Medicare tax potentially, right? There's all these things that add up. And so why would somebody still do that though if they said, well, I don't need to sell that position anyways. I just have $500 in my checking account. I could just write a check and just give them $500. Like, why is it more advantageous to just still do the in-kind donation?
I mean, they may have those funds available in their account, but they've already paid taxes on that money that's in their account. And if they do that in-kind donation, that's saving them on the taxes for when in the future they would be selling off that fund or whatever. And then that realization of the appreciation in that account, it's going to be even higher at that point, most likely, right? We expect that over time it's going to continue to appreciate. So you're just saving them in taxes.
So you can use... So the idea is donate the $500 worth of shares today, take the $500 from your checking account, and you would, if you like that company or that fund or whatever, buy yourself a new $500. You can just rebuy it.
Yeah. You're just upping your cost basis for that future, right? Yeah.
So then in the future, if it appreciates next year to $600 and you decide you do need to sell that investment for whatever reason that comes up in life, now you're selling $600 share and you have to realize $100 in gain instead of $400 in gain. Love it. It's one of my favorites for people that want to give charitably. Obviously, you have to want to give charitably, otherwise it like doesn't make sense.
Yeah, you don't want somebody to start just giving money away to charities if that was not part of their values or what they were doing anyways. So.
Yeah. The other place that sometimes I can see the donations making a lot of sense is like I have a client that's on a mission for her church, and so she, in order to kind of fund this mission or whatever, the way that it works is she donates money to her church every single month. And so based on her tax planning, her forward tax planning for next year, actually starting in January, she'll start making that donation with her IRA funds, because she's only going to be out part of the years. And so those donations wouldn't add up to make sense for her to take an itemized deduction on taxes versus a standard deduction. And so she really wouldn't get the tax benefit of the donation to the church. So instead, what we're going to do is send the funds to the church directly from her IRA. It's called a qualified charitable distribution. And in that case, the funds come out of her IRA, and she satisfies her, personal desire for this charitable giving, but she doesn't have to realize the income on her SEP IRA.
Yeah.
So her IRA.
Oh, sorry. I was going to say, can you clarify, is there an age range that is required for QCDs?
Yes, there is. And I think they recently changed it. This client is certainly over that age.
I'm pretty sure it's 72.
72, yeah. Because it used to be the minimum, like the RMD age, but I think they changed it with that, right?
I think so, yeah.
Yeah, it's definitely not 59 and a half. But when you get into those latter years, that is a strategy worth looking at. And the other thing is that it does count as your RMD for the year. So if you're at a position where you have to take money out of your IRAs, and you are somebody that does give charitably, you could consider that as a strategy. And that's, again, only makes sense if you want to give charitably.
Yeah. I think that is a huge one, especially when you're talking about RMDs, those required minimum distributions. It can be a huge benefit, because that's when you're essentially forced to take money out of your IRA, even if you don't want to, right? And so that can impact people's taxes quite significantly.
Potentially some negative impacts to Social Security and the rate that's being taxed.
And Medicare,
IRMA, yep. Capital gains potentially, right? Because capital gains is in a progressive bracket like income taxes normally.
You wouldn't have capital gains on an IRA, but yes.
No, but if you had capital gains otherwise, right? And say you're at 0%, but now you get an RMD and it's, you get an extra $2,000-$3,000 of income, and all of a sudden it bumps your long-term capital gain bracket to 15. You get taxed on all your long-term capital gains at 15%. So that's something that
that's true.
People might take into consideration.
Yeah.
One of the things I have been trying to talk to people about in this tax planning conversation is tax efficiency with regard to investing, and the way that aligns with risk. Particularly in a portfolio that isn't tax sheltered. So if you have an IRA fund, or not an IRA fund, I don't know, it's a fund. You have an IRA or a Roth IRA, or a 401k even, that's what we would call qualified funds. And the way that I describe that to people, which I got from one of my college professors, he described it as like your IRA is like a bus, okay? It's going to a destination, and you can change which seat you're in on the bus. Right? You can get up and move around on the bus. The taxable event is getting off the bus.
I like that.
Right? It's like, so you can change your investments in the IRA or in the Roth IRA or your 401k. There's no tax implications. Yeah. Which makes it then from an active standpoint, like an active management standpoint, you can you can manage the risk differently, because you don't have to rely on the same market mechanisms to try to put together the portfolio for like an all-weather type scenario, right?
Yeah, I feel like it just gives you more flexibility within those accounts.
Yeah. Well, so this is going to be a big example, but it would illustrate the point. If you have $1 million in a brokerage account and $1 million in an IRA, and you have a risk tolerance that you're not you're not very risky. But in your brokerage account, you have, shares of like an index fund, and the market is getting totally hammered. If you want to start making a tactical move and saying, well, I'm going to, like this market has too much risk. I need to protect some of my funds. I'm going to get out, whatever it might be, which is not something that most people probably should do. But that changing and saying, I'm going to get out of the market or something will cause a taxable event and potentially a gain in a year when you're losing money. And so that's not fun. Whereas if that happens in the IRA, right, you can sideline the market and get back in at a later date. Yeah. No taxable event, as long as you don't take a distribution from the IRA. Now, I will say with that, because I know people are probably going to come out of the woodwork to say, Brandon, you can't time markets. What do people can't time markets. And I will say, I will come right back and say, yes, you can, and no, you can't. So you can't time markets. Timing markets is a bad idea if you are saying, I want to beat the market on an absolute return basis. It's very hard to beat the market if you're just, it's hard to beat being long in the market, fully exposed all the time.
Because you have to beat it twice, getting out and getting in.
Yeah, yeah, and it's just there's too much possibility for tracking error, right? Yeah. Like the market has too much volatility. Now, if you are somebody that is risk adverse, right? Hey, I'm within 5-10 years of retirement or something. I want to stay involved in the stock market, but I can't afford a 2008. I can't emotionally handle it. I can't do whatever. Well, you can use market timing as a way to manage that risk and say, I don't want to be invested when the market is giving off signals and telling people that it is not a favorable time to be invested in the market. Now you're going to give up some performance on that. You're likely to give up performance on that, which you can recapture if you use leverage, right? So if you kind of degrade some of the performance, but now you add in the leverage, that's a whole different conversation, right? However, what I'm going to say is there is not a way to build a portfolio and say, I want to, have something that is going to, be guaranteed to not go down if the market's going down, and I want it to go up. Like I want this negative correlation. I mean, I suppose there is, but the carry cost would be so prohibitive, right? And you would just really ruin your return. Whereas if you say, okay, well, I just want something that can get out if the market really is not in good shape, that exists. We do that for people, but you have to be so aware of that on the tax consequences. Yeah. And so that's what leads me into the rest of my conversation here. Now that I've qualified sufficiently, I don't think we can time the market to, double your return and I don't know, whatever. When you come to a brokerage account now, right? So IRAs, you can really just pick your risk tolerance and say, let's go with it. And if, next year or 5 years from now, we change our minds, no big deal. Yeah. On a brokerage account, totally separate issue, because if somebody goes, hey, I'm really risky and I can withstand, and I'll say, if they say this, I can withstand anything. And I have a couple clients that are like, they really can, and have shown me they can withstand any market volatility. And I've seen, tax lots and brokerage statements that indicate they can do that. It's so uncommon, right? Like most people are not okay with losing 50% of their money and just saying, oh, guess it's on sale, I'm going to buy some more. Most people aren't. I have some that are. And for those, hey, okay, let's get some index funds. Let's do this. Let's keep the costs low. Let's keep the tax efficiency high. It's great. There's a ton of great tax efficiency that comes with ETFs versus mutual funds. However, most people don't. Right? Most people are like,
they don't have that capacity.
And they're okay with some segment of their portfolio, right? You want some segment of your portfolio, and that's your risk side. But then, so now it becomes the conversation around, well, what about the stuff that's not risky? What about the lower risk stuff? So we're talking about stuff like your bond side of your portfolio, right? Well, bonds are, and I'm going to say active management, right? Like tactical management, like we talked about in an IRA, or just any kind of active management that's going to rotate through and change the allocation positions based upon market conditions. Those two things are inherently not tax efficient. Because bonds are taxed as ordinary income, because it's interest income. And
which for those of you listening, that's going to be those tax brackets that we talk about, right? That's the ordinary income.
Yep. And short-term capital gains, how's that taxed?
And short-term capital gains rates.
Which is the same as ordinary income.
So
right?
it's
So
higher rates.
Yeah. So one of the things I have been trying to help people understand is that, hey, if you want tax efficiency, we can do it.
Mm-hmm.
It usually comes with carrying a certain amount of risk that you have to be okay with. And if you're not, then you're talking about bonds. And if you're okay with bonds, then you should be okay with some different alternative ideas if it gives you a better return expectation than the bonds would have.
Yeah.
Right. So in that, like, we have a covered call strategy we use, and that is something that produces income, and it has income typically higher than a lot of bond opportunities, potentially some different risks than bonds, but from a tax perspective, it's not any less efficient than like owning the bond.
Yeah.
With a caveat being, obviously, if we're talking about treasuries, it's state income tax exempt, which is some tax efficiency, but only a marginal amount.
Yeah.
Anyways, there's my rant on long, tax efficiency in the brokerage model comes with typically more risk.
Yeah.
There's one tool that I've found recently that does actually a really good job at spreading the difference. It captures the tax efficiency in a really big way. But manages the risk. The downside risk. Then. Yeah. And I don't know that compliance would love me talking about it on.
Okay. I was going to ask if we could dive into that.
But I've been using those the last couple of years, and those have been great for the people in the middle, but there's really only one scenario. And what I'd say is it's not, for anyone listening, an annuity. And
it has a lot more liquidity to
and
it
annuities,
than an annuity would have.
Annuities, illiquid typically, and not very tax efficient. One of the things I don't like about annuities that people don't talk about enough is that, remember that when you take the money out, the earnings on that is taxed as ordinary income.
All at the same time.
So even if you have a tax efficient idea or strategy, but it's in an annuity wrapper, it's going to get taxed inefficiently. Okay.
Yeah. So if you're interested in what we're talking about, reach out to us, because I'm not sure compliance would like us to talk about it here.
Well, if somebody has a brokerage account and it's a sizable enough account that if you lost, if you had a drawdown or a loss in that account of a size big enough that I would say, like, if a 25% loss in an account like that would make you really just not know what to do with your life, it was going to really be a meaningful difference. It's time to get some help.
Yeah.
And if you already have an advisor and you're feeling uncomfortable because they aren't managing that risk, then it's time for a second opinion too.
Absolutely.
And y'all know where to find us.
Another thing, since we're on the topic of tax efficiency and different types of accounts, like you mentioned, the IRA, the Roth, and the brokerage account.
Yeah.
Let's talk a little bit about Roth accounts, if that's okay with you.
Yeah, absolutely.
I think, especially right now towards the end of the year, that's kind of becoming more of a conversation that a lot of people are having, is thinking about Roth conversions and Roth accounts. So what have been like some recent experiences of yours around Roths, or what are you doing with Roths right now?
Yeah, I think the biggest thing I see this time of year is people that want to put money away, but they have this good and bad issue on their hands. And what I mean by that is they have an IRA, like a traditional IRA. They make enough money that they're over the contribution limits for a Roth IRA. And they want to, so then they hear about on social media, well, I can backdoor Roth. The issue with that people should be aware of is what's called the pro rata rule. And again, we're going to use some simple numbers here. So we're going to say you have a $9,000 IRA and you're not qualified to do a Roth IRA directly. And let's call it a $90,000 IRA, because that's a prohibitive number that you can't convert the whole thing. You have a $90,000 IRA. And somehow you're going to get $10,000, which is over the contribution limit. But we're just using simple numbers here today.
Just forget about contribution limits right now.
Yeah, you put $10,000 in this IRA because you don't qualify to do a Roth. And so you can still do an IRA contribution, but it's what's called a non-deductible contribution. And so it goes into the account as what's called cost basis. Okay. Cost basis is important to track. It gets tracked with the IRS form 8606 when your accountant does your taxes. And it's important because in the future, when you take money out of your IRA, right, part of the money you're taking out is the cost basis. Well, you've already paid money on that because normally IRA funds are tax deferred, but you didn't qualify for the deferral. You still put the money in. And so you have paid the money on the taxes on that money. So as you pull that $10,000 out in the future, right? If you put you have 90,000, you put 10,000 in as cost basis, or, you end up with an IRA that's $100,000 total, $10,000 worth of cost basis, $9,000 worth of tax deferred, either contributions or gain, right? And, you're in retirement, whatever, you pull a distribution out of $10,000. Well, $9,000 comes out as ordinary income. $1,000 would come out as your cost basis, which is non-taxed, right? Because you already paid taxes on that money, remember?
Yep.
And so that's what the pro rata rule is. It's saying when money comes out of the IRA, it comes out equally weighted, if you will, between the tax deferred and the cost basis. So now the problem becomes when you try to do a Roth conversion, that's the same thing as a distribution. In a lot of ways. And so if you say, well, I want to convert that so I want to put the $10,000 in and I want to convert it to Roth. What ends up happening is $9,000 comes over that was pre-tax, and $1,000 of the basis you just put in goes over to the Roth. And so now what happens is you've now, in likely one of your highest income years, because you're phased out of Roth already, you have added an additional $9,000 of income you have to realize in this year, and you ended up with an IRA now, and your net difference is going to be, you're going to have 81,000 of deferred funds, and you're going to have $9,000 of cost basis for a $90,000 balance again, like you started with. And you're going to have an 8606, and you're probably going to have an accountant scratching their head, right? And so you have to be careful with the pro rata rule on a Roth conversion.
Yeah.
Couple things you can consider. You could, if you're okay with the investment options in your 401k, you could potentially roll funds into a 401k if you have it. 401ks don't look at the pro rata rule. So the pro rata rule only looks at IRA funds, not 401k funds.
Yep. So that's one way to kind of get around the pro rata rule.
Now you have to be okay with the investment selections in there, or you have to be okay with a bunch of paperwork and your money being out of the market for a time because you're going to roll it into the 401k and then roll it back. And then it becomes like, what do? You do this every year. Sometimes what you can do is look and say like, well, maybe if it's a married couple, one spouse has a smaller IRA balance and the other one has a larger balance. So, like say one spouse has a couple 100,000, the other spouse has 15,000. Well, you could look at, and there's not 401ks to roll stuff into. You could look at just doing if it makes sense in the current year, do a Roth conversion on the full like 15,000 of the smaller account because they're individual retirement accounts. So the pro rata doesn't look at all the IRAs of the couple, just per person. So then one of the spouse could perform a backdoor Roth every year that way. That's an option. For people that are entrepreneurs and they're self-employed, one of the things that I really like is a solo 401k, which is actually really not too complicated at all. Yeah. If you don't have any employees, right? If you have any employees, you're like totally not qualified for this. But what you can do is set up a solo 401k. We custody at Charles Schwab, and at Charles Schwab, they offer this as an option. It doesn't carry additional fees or costs. And you can roll your IRA funds into what is now a 401k. You can still have the same management you had on it before. You can still do all that. So it's quite efficient that way. There's maybe some additional administrative reporting you have to be kind of aware of and work with your accountant on. So it's not a effortless thing,
right?
But it gets the IRA funds sort of out of the way to then go, put money in as cost basis and convert the whole account. Because remember, if you convert the whole account, there's nothing to pro rata the whole account's basis. A workaround that doesn't work is you can't open like 2 IRAs and say, well, I put, this account is all tax deferred and this account was cost basis, and I'm going to convert over the one that was cost basis.
The IRS will look at both of those.
The IRS looks at a cumulative balance, and so your account has to file it that way. And so that workaround doesn't work.
Yeah. Okay. Now that we've sufficiently confused everyone about backdoor Roth, I'm just kidding. That was a really good explanation, by the way.
Yeah, I talked recently. So I had a client recently we're going to do this for, and I said, hey, you mind if I just call your CPA and just run it by him? I just want to make sure he's good with the way this is going to file out. I'm not missing something.
Yeah.
And he's, in support, right? He said, yeah, not a problem. Please give him a call. And explain to the accountant what I was trying to do, get the IRA funds out of the way, backdoor Roth, not have an 8606, no pro rata rules. And the accountant was like, I can't believe this. I can't, and I was like, what? He's like, this is really outside the box. You're thinking, and, and I'm like, really? And he said, like, yeah, you would really be surprised how many advisors don't know about the pro rata rule. And they just start having, clients Roth convert stuff. It creates all kind of messes for us. And we got to be the bearer of bad news in tax time. And, then the client doesn't want to hear it, that it was their financial advisor that caused, them to pay a bunch of extra tax and have these issues. And anyway, so it's a really mess. I guess I didn't realize the bar was that low, though. Apparently it is. But that's why we call accountants and just say, hey, can you double check our work? Because you're going to be the one filing this, and we want to be a team with you. We don't want to try to, replace you and do your job. But our job was to try to do some planning, and that's what we did. Yeah. And it's going to be super beneficial for the client.
Absolutely. It makes a huge difference when it's done correctly. So awesome. So if we got
like 5 minutes left,
a couple more minutes, let's talk about Roth, just regular Roth conversions.
Okay.
Because I think we talked about the pro rata with backdoor Roth contributions, right?
Yeah.
And I guess conversions.
Good job bringing me back.
Let's come back around. So for most people, I think for like the average person, they're going to be looking at a Roth conversion.
Okay.
And so for people who are, let's say, like who's a good candidate for a Roth conversion?
I would say the people that tend to be the best, like if you fall into this demographic, you really want to be looking at Roth conversions. This may be your opportunity. If you retire early, or, pull back from your career, your main career job, and you start working like part-time or a hobby job, or you just do some consulting work or something like that, right? So your income is dropped, your active income, but you haven't filed Social Security yet. And that is like the golden window oftentimes to do Roth conversions.
Yes.
Because you don't have any Social Security, you're going to force to get taxed at a higher rate, right? You're, especially if you're before Medicare age even, right? You're not going to mess with AWMA. Yep. And getting the surcharges on Medicare costs. And you're typically now in a better looking tax bracket than you were just a couple years prior. Yeah. Right. So early retirees, you got a big 401k, big IRA, and that's your window to start doing some significant Roth conversions. Yeah.
That's awesome. I had a client. She's a new client. And so I was meeting with her and her husband, and she works at the hospital, and she's like, so I have this 401k, I'm still contributing to it. Should I be doing a Roth conversion? Because I know a lot of my coworkers have been talking about it. She's like, but they are older and they're looking at like retirement soon. Yeah. So I know that those conversations are happening out there amongst people of, what is a Roth conversion? Should I be doing it? And having those thoughts of like, am I missing out on something? Like, is this something I should be doing? But I think you hit it right on with giving a really good generalized demographic of who should really be considering those Roth IRAs or Roth conversions. Obviously, everyone's situation is a little bit different, right? And you should consider that. But I do think, she and her husband right now are in their highest earning income years that they've been in. So that is not a good time to be looking at Roth conversions. So especially right before Social Security and Medicare come into play, that's a great time when your income is a little bit lower to look at Roth conversions.
Yeah. I think the other time comes down to market timing too.
Mm-hmm. As you were talking about risk earlier, I was thinking about that you'd mentioned, like when the account comes down and we're looking at that from a tactical management. I'm trying to remember exactly what you'd said there. But normally that's not the best time to sell and get out of the market, right? But if we're looking at doing Roth conversions anyways, that could be an ideal time to complete a Roth conversion, because if you have, let's say you have an account that is $100,000 value, right now, and then we go through a recession or something, and now your account value is at, let's say, $75,000. If you do a Roth conversion when your account value is $75,000, then you're only paying the taxes on that $75,000, and then you can allow it to grow back in the Roth account, and it's going to come back, let's say, to that $100,000, but you only had to pay the taxes on that $75,000 when you did the conversion, right?
Yeah. And as a point of clarification, you don't have to convert like an entire account. Right. We're just talking about, an arbitrary number. You can convert, can convert $10 if you want. You can convert whatever.
I'm not sure that would be super.
I mean, like, I'm not going to do it. I'm not going to do it for you, but I guess what I'm saying is like, there's no, and I'm not recommending anyone convert any amount of money. But there's no law that says you have to convert like the entire account or a minimum amount. Yeah. Right.
Yeah. There's lots of flexibility with that.
Yeah. Let your tax projections guide your Roth conversion ideas.
Yeah. I guess to finish up here, because I know we're running out of time, I just wanted to mention how important tax diversification is when it comes to retirement planning. This is a conversation I've been having with a couple of people recently, that they just didn't quite understand what tax diversification is and why that's so important. So these are some of the pieces that we're looking at when we're looking at a full financial plan and looking at that comprehensively. And if that's not something that you have or not something that you're aware of, whether you're doing it on your own or you're working with another advisor, I highly recommend that that's something that you talk to your advisor about, or come and see us and do a consultation to find out how you have your accounts diversified, not only in, different types of assets, but in taxes as well.
Yeah. I think one of the things people sometimes miss on that too, in closing here, is they think, well, taxes are always going up. Taxes are going to go up or whatever. So I need to get all my money out of, my 401k, and to get all out of my traditional IRA, and I should get it, all into Roth or all into, life insurance or whatever. Right.
Yeah.
And the truth of it is that's flawed thinking. And to his credit, David McKnight, who wrote the book Power of Zero, which he is a big advocate of, this 0%, this idea of 0% tax bracket retirement. He really likes the idea of index universal life as a key part of that planning, right? So he's kind of adjacent to this crowd that oftentimes, pushes this on people. They're this idea to convert everything to Roth all the time, or get it into universal life insurance or whatever. And in his book, he spells out like, no, you should still have some kind of, if you want to be truly tax efficient, you want some kind of deferred funds. And the reason why is because the standard deduction still exists. So there is an amount of money that you can take out every year and just from a standard deduction, go back to zero income. And so if you're not utilizing up the standard deduction in your retirement planning because you went all Roth, all tax-free, then what you're doing is you're paying more taxes today than you needed to.
Yep. Right? I think a lot of people forget about that. Thanks for bringing that up, because it's huge.
Yeah. And gee, I mean, a brokerage account that has built-in gains over the long run and being able to strategically harvest long-term capital gains at a 0% tax bracket is really beneficial for a lot of people's planning. But you have to plan that ahead. You have to actually have, built-in gains to go harvest. Yep. Right. So you have to you got to give the cake enough time to bake in the oven.
I like that.
So.
Yeah. True.
And to that point, right? What's the old saying, right? Like, if you put something in the oven and it's supposed to be in the oven for like an hour at 300 degrees, You can't put it in the oven for 1 minute at 9,000 degrees and get the same result. It's like not how it works.
And you don't want to keep opening the oven door and checking it the whole time either, because that's going to impact it too.
Yeah. But at a certain point, you do want to open it up strategically and say it's time to probe this and figure out how close we are to internal temp. And, maybe it's time that it's getting close to being done. We want to maybe monitor that more closely, because you only get one shot at making a Thanksgiving turkey, right? If you burn it, the whole thing's ruined pretty quick.
Yeah, it's true. I'm thinking of a cake where if you keep opening it, it's just going to start sinking down.
Yeah. Yeah. I'm not a baker.
Yeah. You got to wait till it's right about finished. And then
I'd be better with like the smoker analogies, like
that makes
some
more
ribs
sense.
on the smoker. And
Stick the probe in there and
I do like my
it.
Traeger. Yep.
Anyways.
Officially not brought to you by Traeger.
Be our next sponsor.
Which we can't have, but anyways, cool. Well,
right.
Hey, let's jet. Appreciate everyone tuning in. And you know where to find us if you ever have questions about your personal tax planning.